Investing sounds like a big deal to many people. It is difficult, takes a lot of time, and you can lose money. It's a good thing you clicked on this video. I'm going to tell you that investing is easier and safer than you think by starting with ETFs. I am the Anonymous Businessman, and I enjoy helping you with financial and business topics. Please subscribe if you want more and like the video if it was helpful. ETF stands for Exchange Traded Fund. It is a group of shares that you can buy. An ETF is tradable in the same way as an individual share. Because of this, you can easily create a spread in your portfolio. It all started in America with Vanguard. Vanguard is an asset manager and nowadays one of the most well-known providers of ETFs. They make the groups of shares they call an ETF. Other well-known providers are VanEck, State Street and BlackRock. ETFs come in all shapes and sizes. You have ETFs that follow a stock exchange, such as the S&P 500, Dow Jones and AEX. They contain all or the most important shares of the stock exchange in question. The S&P 500 is formed by the 500 largest American companies. These are often multinationals that are active around the world. Think of companies like Coca-Cola and Apple. You also have ETFs that focus on a specific sector. Think of the energy and real estate sectors, or even more specifically, sport and electric cars. These are just examples. But why do you want to invest in an ETF? The first reason to invest in ETFs is because it is an easy way to buy diversification for your portfolio. It depends, of course, on the ETF how good the diversification is. As mentioned earlier, pay attention to regions and different sectors. In addition, the number of shares in an ETF is a good indication of the spread. The fewer companies in an ETF, the higher the risk, but the higher the returns can be. Then the second reason. ETFs usually have very low management costs, often between 0.1% and 0.5%. In comparison, investment funds often charge more than 1%. This is because mutual funds are actively managed while ETFs are managed passively. Passive means that the ETF is only rebalanced once or twice a year. This is usually done automatically by a computer. These low costs make ETFs a cheap way to invest and to start with a lower budget. The next reason is about risk. Because ETFs consist of multiple shares, they have a much lower risk than individual shares. If one of the shares in the ETF does not do well, other shares can make up for the loss. However, it is important to pay attention to the spread between sectors and markets. What you often see is that a whole sector is affected. Think of the aviation sector during the Corona crisis. Last but not least, the return that can be achieved by investing in an ETF. Tracking an index often leads to higher returns over the long term than selecting individual stocks. 95% of the investors do worse than an ETF over a 10-year period. ETFs are therefore very good for the long term. This is the end of the video. I hope that everything about ETFs has become a lot more understandable. So, investing is easier than most people think. Of course, it is very important to research the ETF you want to invest in beforehand. If you want to see more videos like this, please subscribe to this channel. I hope to see you next time.